Good morning, good afternoon, good evening, wherever you're listening to me. Welcome to another episode of Wealth Building Conference. My name is Oludare Fasola. Tonight, we're going to be talking about tax efficient planning for medical professionals and business owners. And I want to assure you that we're going to learn a lot today because it's fully packed with practical strategies and how I've been helping medical doctors in the past. So as you are joining, please, I want you to do me a favor by type your name and you are joining from. If you are joining from any part of the world, just type your name and where you're joining from. Again, this program, this event, live event is going to be interactive. If you have any question, please drop it on the comment sections. I will attend to that as soon as I finish the live event. Again, this is not just a theory, all right? It's a strategy, it's a practical strategies that I've been using for medical professionals and has been working. So if you know any medical professionals or business owners that is looking to build well, retire, efficiently, like, retired, but pay less taxes, please let them join this session today. Because why? In my experience dealing with medical professionals and business owners, one thing that I realized is that retirement is extremely expensive because they are business owners. They have to plan for their retirement. But how well are they able to plan for that retirement in a tax efficient way? There's difference between planning for retirement, but of course, planning in a tax efficient way. So I'm going to show you what I've been doing, what other medical professionals, smart medical professionals and business owners have been doing, working for them, and how you can also implement these strategies in your own retirement planning. So I will quickly pull up my slide and go into the presentation. Once again, today we're going to be talking about tax efficient retirement planning for medical professionals and business owners. So, but before we go in, right, let me quickly make a disclaimer that this presentation is for educational purposes and does not constitute tax, legal, or investment advice. Please consult your accountant, tax professionals, and licensed financial professional before implementing any strategies, please. All right. Now, let's look at what happened to medical professionals and business owners, right? High income does not guarantee a comfortable retirement. If you agree, put it on the comment section that I agree. High income does not guarantee comfortable retirement. I was speaking to a medical professional one day, and he said, Mr. Fashola, you know what? I have a friend who is a medical professional that retired early. He has a very big house. As a matter of fact, he's making so much money when he's still actively working. But when he retired, he has a big house. He's struggling. Like, he wants to sell the house, but he couldn't sell the house because he actually bought the house as part of the strategies to retire early. Because, in this part of the world, if you have a house, as you are paying your mortgage, you are building equity on that house. Now, when you retired or when it is time for you to dispose of such assets, whatever gains, right, that is accrue on those assets is also another way of retiring. Like, you can put that money in an investment or put it in something that could, be giving you, streams of income. But it's funny that this particular medical professionals find it very, very difficult to sell the house. Let me tell you the major problem that medical professionals and business owners face. Number one, doctors and business owners earn more but often retire with less than expected. According to MD Financial, they did a survey of some medical professionals, and what they found out is that a lot of them delay retirement as a result of the fact that they will run out of funds. Like, it's not that they don't want to retire, but they find out if they retire, they will run out of funds. So if you are planning for retirement, right, the question you need to ask yourself is this: how strategically am I planning for my retirement, right? The money I'm actually putting aside for my retirement, what is going to happen to it if I start assessing the money? Will tax eat up this money quickly, or will this money actually last me longer? Because if you live long, right, chances is that whatever you put aside may not be enough for you to retire early, right? Uh, and I've seen this a lot, right? Taxes, lifestyles, inflations, and poor structure. So one of the major problem is this, right? That seen affecting medical professionals is number one, taxes, right? It is not how much you earn, it is how much you can save from taxes. I have been saying this over in my presentation that tax is number one biggest destroyers of wealth. If you are making money but you don't know how to properly structure your income, right, you might not be able to build wealth and retire comfortably. Life size inflation, right? You have high income and immediately you upgrade your lifestyle. This is another major challenge that medical professionals and business owners are facing. And of course, the way you structure your income. How do you structure your income? Do you structure it in such a way that taxes and other, lifestyle inflations, or this your income will not last you? So it's all about planning for retirement. It's all about how do you structure it in such a way that this money will last me as long as I live to enjoy my retirement. Again, let me tell you the solutions today. Do you know that as a medical professional, as a business owner, do you know that you can earn so much and you can still legally keep a lot for your retirement? So it's not how much you make, but it's how much you keep, right? This is the tax trap, right? Now, if you are making money, right, you could pay between 45 to 53% in personal taxes in this country. And I'm talking about Canada. I don't know what is sustainable in other countries, but of course I know in other countries like United Kingdom, like United States, it all depends on their tax system. But the thing is this, right? Let me explain this in a very short way. As a medical professionals, if you pay yourself, depending on your tax, depending on your province, you could pay up to 45 to 53% in taxes. I mean, like, if you pay yourself salary, if you pay yourself dividend, it all depends on your province. You could pay up to 53% taxes. Again, if your corporation make money, okay, you make your money from your corporation. Say, for example, your corporation make $500,000. You claim maybe 200,000 of expense. They tax that one at 12%. The remaining money, right? If you reinvest that, which is the gains, like the profit you make from your corporation, and you reinvest that, and you make gains on that money, you could also pay up to 40 to 53% in taxes, right? Now, for every dollars you earn, it is very heavily taxed. Think about it. I just want you to think about it. Grocery, you pay taxes. Everything, gas, whatever, you pay taxes. It doesn't make sense for you to still make money from your corporation and you still expose that money to serious capital. And this is why it is very difficult for a lot of you to retire comfortably, because why? Those money that you'll have put aside in different strategies to make your retirement much more comfortable, CRAs has actually take chunk of it, right? You look at it. Most medical professionals and business owners overfund the CRA and underfund their future. That is what is happening to a lot of medical professionals and business owners. But of course, there are solutions to all of these, which I'm going to show you in this presentation. And what I'm going to show you today is what I've been showing other medical professionals. I've been working for them. Number one, register retirement scheme. This is why traditional planning fails high earners. Like everybody knows in this country that RRSP has a limit depending on what you earn, right? If you open my CRA, you're going to see it This is what you can put in your RRSP. If you put more than that, you're going to be penalized. TFSA, right? I think it's about $7,000. So if you want to retire, comfortably as a business owner, how much is $7,000 annually? And this is just for the years, right? We don't know what's going to happen next year, right? Now, if you now think about it, right? If it is 7,000, even if it's $10,000 you're putting aside on your TFSA, let's say that is the room, right? How much do you think that will actually give you when you retire? Again, pension problem, right? Real stable for professionals. So you as a medical professionals, except you pay yourself salary, you don't entitled to any form of pension. If you pay yourself salary, or maybe you actually use your corporation to plan for corporate pension, you don't have anything to show. You don't have any pension at the end of the day. So now, what is the solution? And again, corporate cash silently eroded by taxes when left idle. Now, I've seen a lot of medical professionals, they have so much money in their retained earning, but they're actually afraid of taking that money out because what? If you have money in your retained earning, if you pull the money out, if you invest that money and you make gains on that profit, on that money, you want to enter into another tax regime. So they're afraid. But there's a solution to that, right? What you don't know, you don't know. I understand you are medical professionals, you are not taught about financial in university. You need to meet financial advisors that understand how money works, not your accountant. Because why? The job of your accountant is to make sure that he help you to prepare your books of account, help you to present it to CRA, file your tax. If there's any audits, they have, stand for that. But a lot of you actually wait for your accountant to come and say, hey, you need to plan for retirement. Your accountant will never tell you to go. Like, your accountant will not tell you to go and plan for your retirement. It is your responsibility to sit down with financial professionals that will guide you on how you can properly, efficiently, strategically plan for retirement, right? Traditional tools were not designed for high income professionals. And you've seen it, right? If you rely on all of these for retirement, you might really you find it very difficult to retire comfortably. Let's look at the power of incorporation. Many of you incorporate, but you don't know that it's one of your powerful engine for retirement. Now, number one, decide when and how you pay taxes. One of the major reasons why you have your corporation is, number one, for tax planning, but most importantly, it's another powerful strategic engine that you can use to retire, comfortably, right? Because it allows you to defy a lot of money in your corporation, which is going to be like, give you a tax advantage over the years. But, if you don't talk to people that really understand how to properly structure this, you might find it very, very difficult for you to retire early. All right. Retain earning at reduced corporate tax rate. Like, this is what is happening, right? I met some medical professional last year, and the problem is, right, Fasola, I have a lot of money in my retained earnings, but I don't know how can I put this money to work in such a way that I'm not going to pay tax on it, and I will still achieve my financial objectives in terms of maybe they want to also diversify into real estate, they want to buy stocks, they want to go into franchising. Now, and I said, look, it's very simple, because this is what I've been helping other medical professionals to do. Like, whatever you have in your corporation, right, let's put it into a powerful strategy called immediate financing arrangement. You put the money in. As you are putting the money in, you have access almost immediately, or maybe in the second, third years, you have access to that money just to go and do your, say, for example, you have retained earning of $200,000 in your corporation. Okay, you pull out retained earning, you put in the immediate financing arrangement. That same money, right? Maybe the second year or third years, you have access to that money. You borrow the money back at, let's say, for example, 4%, 4.5%, depending on the carrier, depending on the advisor that help you to set it up, depending on the lender, right? Let's say, for example, you are paying 4.5% on $100,000. That is $4,500. Guess what? That $4,500 that you are paying on interest can still be written off to your medical corporation that will further reduce your taxes. Imagine that. of which your money is growing, compounding, tax-free in such a way that you can still use that money for retirement planning in future. Think about it. If you put this money in a taxable investment, let's say, for example, in stocks or bonds, if you make money on that, you pay capital gain taxes. Let's say, for example, you put $200,000, you make $300,000 on that, divided by 250% of that is going to CRA. But in this arrangement, you put the money in, and your money is growing tax deferred. Plus, you have access to your money tax free. You can borrow the money, right, to do whatever you want to do, and you still write off the interest to the corporation. It is strategies, it is structure, right? See, I'm saying this because why? A lot of you are struggling right now. I mean, a lot of you are thinking, how do I retire? How do I actually put money out of my corporations? How do I put my retained earnings to work? So there's strategies behind that. Their strategy. I was talking to a medical doctor on the side, and they are comparing. Say, no, what if I put my money on mutual funds? Okay, if you put your money on mutual funds, you put $1 million on mutual fund. That mutual fund will also grow $1 million. Let's say in the next 10 years, let's say you have $1 million on mutual funds divided by 2, right? Multiply by 50% of it, depending on your tax point. That is what CRA will take out of that money. But if you put this money on these strategies, it is tax free. Think about that. Okay, it is financial intelligence. One of the things that I want you to know today is that nobody will teach you in the university. Nobody will ever tell you that this is the way to grow your money. As I said, it is your responsibility to sit down with your financial advisor and show you how to retire early, how to put your money to work without being subjected to huge taxes from CRA. Now, your corporation is a wealth engine that transforms your corporation into a growth machine. Now, another way, the reason why you incorporate is also for tax deferral. Now, whatever that is sitting in your corporation can actually be deferred to, like, anytime you want to pull out the money, if you don't spend the money, you don't pay the tax, right? But you can actually put the money there and continue to gain, you can continue to pull it, like, whatever, anytime you want to pay the taxes. But it's a way to save for your money right now from huge taxes. But this is the point, right? You need to sit down with advisors that understand how to properly structure all of this to ensure that you retire comfortably, you retire early, and that money you have worked for in your life really work for you when you retire. Now, your corporation is not just for income, it's your retirement partner. Let's look at the tax efficient framework. And this is what I do tell people. Okay. If you're working, like I've seen many people, right? I want to invest. There's nothing wrong there, right? Investment is in sequence, right? Now, building wealth is in sequence. Now, you cannot build wealth, you cannot invest if you don't first protect the source of that income. Think about it. You are working, you're making money, and you don't protect the source of income, but you want to go and invest. Now, what happens if, for example, the source of that income, let's say you that were making that money, you're unable to work for some reason, let's say critical illness, disability, whatever, is it not important for you to sit down and protect that income? Now, the first thing is you have to protect your income, you have to protect your health, and you have to protect your business continuity, right? Now, anytime one critical illness struck, right, the going concern of your medical corporation is seriously threatening. And I've seen that in many cases where just once critical illness, just they couldn't practice again, they couldn't make money, maybe stroke, maybe cancer, heart attack, they couldn't practice anymore, right? It's funny because why? The first thing you need to protect, the priority, like the most important thing you need to protect is yourself, because you are the only asset that is generating money for for yourself. Like if you don't go to the clinic, you don't make money, right? Number two, you need to ask yourself, like you need to structure, like there is, you need to put a proper structures in place. Is it corporate versus personal income optimization? Like you have a corporation, that does not mean that you should not pay yourself. Like I've seen many people, like just their pension is what actually sustain them, save them when they retire, right? Let me say this. In the last couple of years in Canada, real estate market has been really, 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 uh, uh, struggling. Like it's the whole market crash, right? People, the value of the property just like it happens. So virtually, a lot of people lose thousands, millions in dollars. Now, if you are a medical professional and you plan your retirement, let's say you retire in the last 2 3 years, and let's say 70% of your asset is on real estate, what will happen to your retirement? Like you've been investing, and all of a sudden the market just crash, and all the equity just wipe off. You don't have anything, and you want to retire, and you don't put let's say, because one thing that I like, a lot of medical professionals I know, lot of medical professionals I know, more than 50 60% of their asset is on real estate, because they feel that that is the only way I can actually put my money to work. Let me go into real estate. And of course, a lot of them are also not, they are not also doing it in a proper way. Let's say someone else are just buying the asset in their names, and they are not like, not in the name of their holding company. And at the end of the day, if they incur any losses, because you are not buying it, like you don't really properly declare, because of maybe one real estate professional, just because you want to make money from the commission, just say, hey, you need to buy the house. So, doctor, I saw one house very cheap. They just buy it, and when the market crash, they lose money. They cannot, they cannot actually claim that from their corporation. So it is not the fault of the real estate professional. It is your fault, because why? You don't sit down to do the market analysis and seek expert opinion from professionals that will tell you how to properly structure. So this is the way, right? You need to ask yourself, when do I actually incorporate? Because not every time incorporation makes sense. Yes, not every time incorporation makes sense. Sometimes you may not even need to go and incorporate before you like start wasting your money on incorporation. You need to ask professionals, so does it really make sense for me to incorporate right now, right? Or should I continue to just operate on a personal level as a sole proprietor? If it is time for me to, when it's time for me to incorporate, what are the things that I need to put in place, right? So I think I have a podcast on that, on incorporation versus non-incorporation, when it makes sense. So I have it on my YouTube channel, so you can go and watch it. So, but what I'm trying to say in essence is that you need to ask yourself, how do I structure my my retirement, my corporation, in such a way that it's going to give me tax efficient money when I retire? Again, you also need to look at the shelter. You need to shelter that money, shelter it using RRSP, TFSA, or corporate strategy. There are so many ways in which you can shelter your money. If you do RRSP right now, we call it's a deferred tax strategist. Whatever you put there right now, it's not going to be taxed. They give you a tax return, use that to file your tax. But when you start assessing the money, you start paying the tax back. Of course, you've enjoyed your money right now, right? Even if I'm going to pay the tax later, it's still part of it, because you are, you belong to high income professionals. So you need to save some money from taxes by using RRSP. Of course, TFSA. So the TFSA is a tax sheltered account. Like you already paid the tax, right? So whatever you put in TFSA has already been taxed. So the growth will not be taxed again. Okay, that's just it. But these are some of the strategies that you can actually use, to save your money from taxes. Of course, you also need to look at the corporate strategies like corporate pension plan, corporate insurance, immediate financing arrangement. There are so many strategies that you can actually, depending on your situation, depending on your risk tolerance, depending on your financial objectives. We're going to sit down with you, look at the numbers, look at what makes sense, because not, we cannot, it is not one size that fits them all. We have to look at your situations before you can recommend that this is what is really going to work for you. So it's not like we have to do that again, right? You need to also look at how do you transfer all of this in such a way that I'm not going to be subjected to crazy tax, legacy, estate, and tax-free wealth transfer. There's what called capital dividend account. The capital dividend account is a powerful strategic tools for tax efficient transfer of wealth in a corporation. So I'm going to do a podcast on that maybe in future, just to explain what capital dividend account means. A lot of medical professionals don't understand how it works. I was talking to a medical professional, and he was telling me, say, if I pass, how do I assess my money from that CDA? There are so many things to understand about that. I'm going to come up with what is capital dividend account, how does it work, how you as a medical professional can assess money there tax free. Okay, I will come up with that. But the truth of the matter is that, it is not about, there's what called asset protection and asset preservation. If you protect your asset, right, it's very good. But what about preservation? What about you making sure that generations to come still have access to that money? We all know about Rockefeller strategies, where he actually, what like all he had built for generations unborn still continue to enjoy that money. This is what I want you to also understand as a medical professional. This is the corporate advantage. Okay, number one, corporate owned life insurance, which is a tax advantage protections and growth. Now, if you set up a corporate life insurance policy on your corporation, two things is what it's going to do for you. There are two ways to do that. It's that you set it up on your medical corporation. If you set it on your medical corporation, the corporation is the owner, the corporation is the payer, the corporation is the beneficiary. Because the corporation is the payer, the premium you are paying enjoy, lower tax bracket. If your corporation is paying 12%, again, the corporation premium enjoy 12%. So it's a massive tax saving for you. But if it is set up on the holding company, meaning that the retained earning, the profit of the medical corporation can also be put on retain. They set up the corporate life insurance on the retained earning. So you are actually paying the premium from the retained earning. So the money you put into the retained earning, because it has already been taxed from the medical corporation, it will be tax-free. So you're not going to pay tax on it. The growth there is not going to be taxed on, like if you put this money on another investment strategies where the growth will be taxed at a passive income rate. So you can imagine that. So you need to think about that. I think you need to do that. Do the medical corporation and also do the retained earning. This is one of the very powerful way to retire very comfortably and also pass it on. Again, compound within the corporation. So whatever you put there, it's compound tax free. Like the growth is tax free, and in future you can start have access to this money in a tax efficient way. Tax free distributions to your shareholders. Of course, like you as a medical professionals, you want to think about this, right? That what if anything happens to me, like even while I'm alive, right? Won't I enjoy my money? Of course, if you are like you have 2-3 medical professionals you are practicing together, you can actually do this together, and the capital dividend account actually use that to distribute it to other shareholder. Is a powerful strategic engine to retire early and to retire efficiently in this part of it. You know what it's going to give you? It's going to give you more control, and you pay less tax. Plus, this will give you a greater legacy, which means that your families will also have an opportunity to enjoy what you have labored for. This is a real life story of a surgeon that I met last year. This particular surgeon was earning about $450,000, right? But you know what? It's losing almost about $180,000 to taxes because of the structure, right? Now, it is not how much you make. If you are a medical professional and your case is like this, and not only one, not two people. Like I've met a lot of people lose money to CRA. I sit down with them, restructure their finances, restructure the way they actually they save their money, and they are able to save a lot of money on taxes. And we also put a plan for them to start, their retirement plan in a tax efficient way. Don't forget that everybody plan for retirement, but how do you plan in such a way that whatever you've labored for is still like you have it in a tax efficient way? So now what happened is that there is a high taxes and inefficient structure. If you don't meet advisors that really understand how to work with medical professionals and business owners, they might not really understand how to do that. When we finish working with these medical professionals, me and my team, we're able to reduce the taxable income, right? So this is not, and this is a real life situation. It's a real life scenarios of a medical professional I worked with last year. We are able to build a corporate wealth plan for him, right? So, from there, as you can see that, I can retire comfortably in such a way that I have enough money to enjoy when I retire. And of course, I have a lot that I'm going to still pass to my beneficiary. We are also able to create tax-free retirement income in we have a plan, like, every year, a certain amount of money will be going to these medical professionals in a guaranteed way. Like, this is not subject to market volatility. This is not attached to the market. the ups and downs of the market. No, this is actually in a guarantee environment, in a tax-free environment. You as a medical professionals, you want to like explore this kind of a strategy. So, and of course, secure multi-million dollar legacy. At least I remember by the time these medical professionals reach age 85, the amount that we have in actually in the strategy is roughly about $6 million. After these medical professionals already enjoyed, number one, he has actually pulled out $1 million because he actually put the money in and he have access to the money. Again, this particular medical professional was able to buy a lot of franchise. We were able to put some franchise in place for him. This is aside the fact that he puts the money in these strategies, he's also have access to the money to also go into other investment strategy, investment, like we're able to also get him a franchise. At least I remember we were able to get a Tim Martin for this particular medical professional. So what you don't know, you don't know. But what I'm trying to say is that all this information are out there, but you also need to do your due diligence before you ask medical about advisors on how they do all of this. So look at it, the same income, but we get a different income outcome completely. It's not about how much they make, it's about the structure. What smart professional do differently? Number one, they build streams. They don't just chase product, they create comprehensive strategy. So as a matter of fact, system in place. Now, if you are a medical professionals and business owners and you don't have a system in place, you will burn out, right? System on how you actually plan your finance, how you run your clinic, okay? If there are certain things that you need to be thinking of automate right now to ensure that you have enough money, number one, you free a lot of time. Number two is that the money you're supposed to be using to pay salaries, you can actually free those money and put it on other investment that will generate money for you, so that it can actually start giving you comfortable retirement. Again, you also must start early, right? One thing that I've seen a lot in medical professionals and business owners is that they delay retirement. When you talk to them, oh, I'll get back to you, and I will get back to you, be like, they will not get back to you. Or some of them will continue to procrastinate till their insurability change, till they don't have enough power to work. If you are working right, you should understand that the more you age, the more that power to work reduces. So when you are actively working, it is important for you to also put something aside in order for you to start planning, so that you not burn out, so that you not regret at the end of the day. Okay, use expert professional who understand tax structures and legacy. So when we are putting these strategies together, you have to coordinate with the accountant of the medical professionals. I have to coordinate with the lawyers of the medical professional, because it's a whole lot of work, right? It's not something that you can just do just like that, right? There are so many things you have to put in place. You have to, if you want to set it up on the holding company, the medical professionals or the business owner must have what you call a holding company. If they don't have it, it's your responsibility. Find them a very good lawyer who works. We have a team of teams that work with medical professionals only. I have an accountant, I have a lawyers across the provinces in Canada to make sure that they get that expert advice from how they have been helping other professionals, right? Again, so treat planning like medicine, preventive, not reactive. Look, you every day, you see the way you carry your work very diligently. That is how you must take your retirement very serious. It's just like that. This is your next strategic move. Number one, I want you to ask yourself this critical question: do I know my real retirement number? If you are planning, like, have you asked yourself, how much on annually do I need for my retirement? And you can actually determine that. That's what I did with that medical professional. Like, when you are working, because you need to check your lifestyle right now. So on average, like, how much do you really need when you retire? We crunch the number, we're able to get a retirement number. Okay. And again, do I know how much tax I will pay if I sell or die? Now, if you are putting your money in a taxable investment like mutual funds, like you're putting your money on real estate, right? Bear in mind that if you are using that as a retirement strategy, you're going to pay taxes when you retire, because all this will be subjected to capital gains, right? So if you understand that, do you have enough, do you have strategies in place that will also, take care of the capital gains, especially when you pass? Now, there's what we call deemed disposition, all right? What it means is that anytime you pass, all your asset is deemed to be disposable, and the reality is that at fair market value, and TRA must take their cut, especially when you have a lot of gain. Some people may actually worth about $10 million while they are alive, $20 million while they are alive. But the reality is when they pass, what they will actually worth may be around $10 million, $5 million, right? Now, because why? When they started putting this money on those assets, the gains, they don't factor in the gains, right? What they want just to do is just to acquire more asset, more asset, more asset. It's good, but ask yourself, how much tax do I need to pay when I retire? And again, do I have a written tax efficient plan in place to make sure that if I have so much asset, I have enough to take care of those when I retire? So if not, your future is being left to chance. So you need to talk to advisor. So let's quickly summarize what we've been talking about. Number one, these are the key takeaways for you as a medical professional service owner. Number one, high income, it doesn't guarantee financial safety. That's number two. Taxes are your largest hidden expenses, not your mortgage, not your payroll. Taxes is number one biggest, largest hidden expenses. Three, traditional tools are insufficient for you to retire effectively in this part of the world. You need to seek other alternative ways to plan for retirement. Four, incorporate create opportunity. Always from today, begin to see your incorporation as a powerful retirement strategic engine that you need to partner with, right? You have to maximize that for you to retire, right? Strategy beats salary. You need to ask yourself again, do I pay myself salary? Do I pay myself dividend? How do I invest my retained earning? Do I actually put it in a taxable or non-taxable investment? What exactly do I need to, what are my retirement number? These are strategies, okay? It is strategies, it actually beats salary, it beats dividend. Of course, legacy requires structure. We've seen a lot of people, they make so much money, they retire, they have nothing to show for it. It's not about how much you make, it's how much you can save. It is structure, right? Retirement is not an age, it's strategy. Let me repeat this. Retirement is not an age, it's strategy. And retirement is very expensive. It's very, very expensive. You got to plan for it. So if you are looking to plan for retirement, right, you can book a strategic call with me. I'm going to show you how I've been helping other medical professionals to also plan for retirement, so that we can turn your income into a lifetime advantage. So I want to say thank you so much for all the people that have joined today. It's really, really an amazing session today. I believe you have gained a lot. If you are here as a medical professionals or business owners and you have been thinking of how do I retire early, or how do I plan for my retirement, this is time for you to actually put into work. Don't just come to the webinar like this and listen to it, right? Please implement what we are discussing here. It's very, very important. So I want to thank everyone that joined today. Bankole Abejide, thank you so much for joining. Olubola Fasola, thank you so much for joining. I really appreciate your time. So next week, we're going to be talking about another topic, 8 p.m. EST. My name is Oludare Fasola. See you next week, and bye for now.